Investors were excited about Amazon stock after the company reported quarterly financial results that included an acceleration of its AWS revenue. That segment is the most lucrative of Amazon's segments overall and provides an operating profit margin that's multiple times higher than its e-commerce segments. So I'm going to discuss in more detail why so many investors are excited about Amazon stock again.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Amazon CEO Andy Jassy reported that in the third quarter, their revenue was over $180 billion in a single quarter, and that was up 12% year over year. Operating income was flat at $17.4 billion, but it was a result of a couple of one-time expenses that are not likely to repeat. Trailing 12-month free cash flow at $14.8 billion. The company generated free cash flow. That's after all of their investments in their data centers optimized for artificial intelligence. So even after spending roughly $125 billion on capital expenditures in the previous 12 months, they still had $15 billion left over. That's what makes Amazon such an exciting business, is because at such large scale, it gives them the power to invest in these innovative technologies and still have capital left over. The management team highlighted that AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year, their largest growth rate in 11 quarters. Now, what that means is over the previous 5 quarters, at least, the growth rate had been decelerating. So it had gone from 19% for a couple of quarters and then down to 17% for a couple of quarters. And then all of a sudden, it jumped to 20% above where it had been going all the way back 11 quarters. So that's exciting for its most lucrative segment, which generates profit margins close to 35%, but as low as 30% in some quarters, but usually between 30 and 35%, whereas its e-commerce segment generates profit margins, operating profit margins in the mid-single digits. So it's multiple times more profitable than the e-commerce segment. So growth in this category is more exciting for Amazon stock investors. And thankfully, this segment is growing roughly twice the rate of the business overall. So it's growing twice the rate of the e-commerce segment. So as this segment grows proportionally faster than e-commerce, Amazon's profitability could continuously move upward, which is what you have seen from Amazon's operating profit margin. If you look back a decade or 2 decades, it's showing a very nice trend upward. Now, Amazon is alluding to competitors here, saying that it's worth remembering that a percentage growth is a relative term, meaning it's easier to grow your revenue at a faster percentage if you're generating less revenue. So if you're generating $10 billion in revenue, it's easier to grow by 40% versus if you're generating $100 billion in revenue, it's more difficult to grow at that rate. And that's a shot at its competitors, Alphabet and Microsoft, which did generate much faster growth, roughly twice the rate of increase as AWS, closer to 40% growth for Alphabet and Microsoft, but they're on a smaller scale. Amazon's web services segment is larger than those 2 segments. And so that's what the CEO is pointing out here. Amazon did report that its backlog grew to $200 billion by the end of the third quarter, and that doesn't even include several unannounced deals in October, which together are more than our total deal volume for all of Q3. I wonder if this includes the OpenAI deal they announced yesterday, I believe, the $38 billion deal over 7 years. I wonder if that's what they were alluding to in the new deals in October, or if this OpenAI deal that was announced in November is something on top of this already mentioned increase in orders. Regardless, Amazon's AWS segment is now looking like it's hitting an inflection point where the growth is accelerating and demand in the backlog is increasing. This is what investors in Amazon were hoping for. This is why Amazon share price was one of the reasons why Amazon share price was underperforming in 2025. The other reason, of course, was the risks from tariffs and how its business will be impacted by tariffs, since a large percentage of the products that are sold in the United States on its platform are sourced from outside the United States. And so that will increase the cost of goods sold for those products. And that's a big risk for Amazon. But this is a more important part of the Amazon investing story. So Amazon went on to talk about how a lot of the future value companies will get from artificial intelligence will be in the form of agents. AWS is heavily investing in this area and well positioned to be a leader. And I agree with this statement. Agents offer the potential for great value for many enterprises. And in the simplest form, the customer service agent is the most obvious form of adding value for enterprises. If you have this customer service agent trained with artificial intelligence, with all the company data that you would want it to have so that it can respond to customer questions, this agent can be extremely helpful, especially if you give this agent capability to act and take action based on what the customer requests. For instance, if the customer is requesting a refund, you can empower the agent to provide customers refunds of up to a certain amount, and the agent will grant that refund, and you won't need any human interaction with the customer. The agents can handle all those. It'll be faster. The customer will appreciate the speed of interaction, and the business will appreciate the lower cost of serving these customers and better serving these customers. So you're adding differentiation and you're lowering your cost of goods sold. That's you're lowering your cost of operations. That's a difficult challenge for many businesses, to find opportunities where you can improve the customer value and lower your cost at the same time. And so when you find opportunities like that, most businesses will lean in heavily into those categories so that they can capitalize extensively on those opportunities. Now, despite the momentum in Amazon's stock price, I still feel these shares are undervalued. I recently bought Amazon stock for my own portfolio a couple of weeks ago, and the current market price at $250 is still well below the fair value for this stock I calculated at $304. Furthermore, when I go to fiscal.ai, my preferred data provider, and retrieve the forward price to earnings ratio at a forward PE of 31.78, Amazon is trading at near the lowest valuation you've been able to buy this stock, going all the way back to 2023. So even though investors are getting excited about Amazon stock, I think there's significant upside ahead at these current valuations. And so I will reiterate, and I have reiterated, that I believe Amazon is one of the best stocks you can buy right now. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.